Welcome back to Gold Rush Reporter, your source for real, grounded analysis on gold and silver markets. Today, we're breaking down a conversation that reveals something deeper than casual talk. It exposes the mindset of experienced stackers, the fears around the banking system, and the reasons why physical precious metals remain a long-term safeguard while the system becomes more unstable. Let's dive into this story and understand what's really going on beneath the surface. The raw dialogue may sound casual, even humorous at times, but the underlying tone is serious. You have someone who has been stacking since the late 1980s, buying silver at just $5 an ounce, long before premiums, supply shortages, and global uncertainty became everyday topics. When he says he bought in 1989 at 50%, he's referring to a time when metals were cheap, not because the world was stable, but because people didn't understand what was coming. His early stacking wasn't luck, it was foresight. But the most revealing part is not the prices he paid, it's the attitude he has toward the banking system. He openly talks about a potential banking crisis and believes Basel III is being delayed because institutions need more time. This isn't an exaggeration. For years, the repo market, liquidity issues, and structural weakness have been major concerns. When someone who travels the entire country in an old truck warns that a banking crisis is imminent, he's not guessing. He's interpreting signals that most people ignore. He mentions trying to convince his friends and family to buy precious metals, but they won't listen. That's extremely common. People are trained to trust banks, rely on digital payments, and believe fiat is safe simply because it's familiar. The younger generation especially feels no urgency. They are comfortable with apps and bank cards, completely unaware that these systems break quickly during stress. The stacker's frustration isn't emotional, it's logical. He sees fragility where others see convenience. Traveling across the country, meeting different people, carrying his metals with him, it shows how deeply he values self-ownership. He prefers physical wealth because it's real, because it cannot be frozen, blocked, or deleted. That is something digital assets, bank accounts, and retirement plans can never guarantee. When he says 1-ounce coins are better for trading, that's practical advice. If the system ever fails, smaller denominations become far more useful than large bars. Let's explore why people resist stacking silver and gold, and why this creates opportunities for serious investors. The stacker in our story repeatedly tried to get friends and family involved, but they simply wouldn't participate. They trust banks, rely on paper currency, and feel comfortable with digital payments. That mindset is widespread, especially among younger generations. They grew up in a system that presents fiat money as safe, with retirement plans and bank accounts marketed as secure. But history shows that trust in financial institutions can vanish almost overnight, leaving unprepared people exposed. This resistance also explains why premiums on silver and gold behave the way they do. Sovereign coins, for example, carry high premiums because demand is limited and concentrated. Private mint products often have much lower premiums, which is where savvy stackers can find value. Even when prices appear to dip slightly, these variations are daily and predictable in the broader scheme. For investors who understand supply dynamics, these minor fluctuations aren't a signal to panic. They are opportunities to accumulate without overpaying. The conversation also highlights concerns about broader economic risks. The stacker references the possibility of a banking crisis and touches on structural challenges like Basel III. While no one can predict the exact timing of a financial collapse, experienced investors know the system is fragile. Repo markets, mass layoffs, and falling employment all signal potential weaknesses in the economy. When traditional investments and banking systems show signs of strain, physical metals act as a safeguard. Silver and gold are not just investments, they are insurance against the unknown. Another point emphasized is practical use. The stacker prefers 1-ounce coins for flexibility, acknowledging that larger bars, while valuable, are harder to trade or convert quickly in a crisis. This is a lesson often overlooked by new investors. Liquidity and convenience matter when stacking metals. Understanding how to balance size, weight, and type of coin or bar can make a huge difference in real-world utility. Finally, the narrative reinforces the mindset of patience and long-term thinking. Accumulating metals over years, recognizing market cycles, and understanding the behavioral biases of the general population allows a disciplined stacker to stay ahead. While others panic, sell, or ignore risk, the informed investor builds a foundation that can weather systemic shocks. Moving forward, let's focus on how economic signals, scarcity, and market psychology affect silver and gold premiums, and why long-term stackers benefit from understanding these patterns. In the raw discussion, the stacker repeatedly mentions how sovereign coins maintain high premiums while private mint products remain more accessible. This highlights a key lesson. Not all silver and gold products are created equal. When supply tightens and demand surges, coins with limited availability or high recognition see exaggerated premiums. Retail investors often chase these premiums, paying more than necessary, while savvy buyers exploit lower-cost alternatives to maximize accumulation. One recurring theme is the perception of scarcity versus actual availability. The stacker notes that coins, rounds, and bars can vary widely in price due to market awareness and collector interest, not just raw metal content. A coin may seem scarce, but it could simply be highly sought after by a niche group. This drives premiums higher, while underlying metal prices remain relatively stable. Understanding these dynamics allows investors to differentiate between hype and real value. Those who grasp this can accumulate strategically, avoiding overpayment during periods of temporary market panic. Economic context also plays a critical role. The discussion references potential recessions, layoffs, and changes in employment, all of which directly impact liquidity and consumer behavior. When jobs are lost or income declines, fewer people are willing or able to invest in precious metals, causing short-term price adjustments. But experienced stackers see this as a natural part of the cycle. Markets are never linear. These temporary dips are often the best moments to acquire physical metals at favorable prices, preparing for the next leg of the rally. Another subtle but important insight is the role of public perception. Many people remain heavily reliant on banks and digital systems, even as systemic risks mount. This widespread confidence keeps metals undervalued in the short term because most of the population isn't buying. Meanwhile, informed investors with foresight continue to accumulate quietly. This behavior mirrors historical bull markets, where hidden demand from knowledgeable participants precedes major price moves. Understanding sentiment and separating it from fundamentals is a hallmark of disciplined precious metals investing. Finally, the stacker emphasizes the importance of adaptability and practical usage. 1-ounce coins, smaller denominations, and divisible assets ensure liquidity during uncertain times. Large bars may hold more value, but are less practical for trading or emergency situations. Recognizing this balance between size, flexibility, and accessibility is essential for anyone serious about building a long-term stack. Now, let's dig deeper into personal strategy, generational behavior, and the long-term planning that defines serious stackers. In the raw dialogue, the stacker repeatedly points out the challenge of convincing family members and younger generations to take silver and gold seriously. Most people are comfortable with the financial system. They trust banks, use digital wallets, and believe fiat currency is safe. This mindset is understandable, but it is also dangerous. Long-term stackers know that reliance on banks and digital systems creates vulnerability, especially during crises when liquidity can vanish or accounts can be frozen. The conversation emphasizes patience as a core principle. Experienced investors don't chase short-term trends or hype. They focus on consistent accumulation. Whether it's a small tube of coins or carefully chosen rounds, every acquisition adds to a foundation that can withstand market shocks. This patient, disciplined approach contrasts sharply with the public's tendency to react emotionally to price swings, leading to overpaying during peaks or selling during temporary corrections. Generational behavior also matters. Younger people are heavily exposed to digital assets like Bitcoin and altcoins, which can be extremely volatile. The stacker notes that when these digital holdings decline suddenly, owners are left with little tangible value. In contrast, physical metals provide real ownership that can't disappear with a glitch in a system. This lesson is essential. Metals are not just investments. They are insurance against systemic uncertainty. Another critical point is practicality. The stacker prefers smaller denominations, like 1-ounce coins, because they are easier to trade or use in emergencies. Larger bars, while valuable, are less flexible. This highlights an often overlooked factor in stacking strategy: liquidity. Having a well-balanced stack, including coins, rounds, and bars, ensures both security and usability. Investors who ignore this risk find themselves unable to act efficiently when opportunities arise or when emergencies demand quick conversion of assets. Finally, the discussion shows the psychological and behavioral aspects of stacking. Enjoyment, travel, and personal experience are part of the strategy. Physical metals offer tangible satisfaction, and stacking becomes a lifestyle rather than just a financial endeavor. Observing market trends, understanding premiums, and maintaining a disciplined approach separates experienced investors from casual buyers. This combination of strategy, patience, and practicality allows stackers to navigate volatility while preparing for systemic disruptions that many overlook. As we conclude this deep dive, the story we followed offers critical lessons for anyone serious about gold and silver. The stacker's experiences demonstrate that accumulation is more than buying metal. It's a mindset built on patience, strategy, and practical use. He consistently emphasizes flexibility, preferring 1-ounce coins for tradability and balancing that with larger bars for long-term security. This balance ensures both liquidity and resilience, which are essential when uncertainty in the financial system is rising. Generational behavior remains a central challenge. Many younger investors are comfortable with digital assets, bank cards, and apps, but this familiarity can create vulnerability. When digital systems fail, frozen accounts or sudden losses can leave investors with little recourse. Physical metals, in contrast, provide tangible ownership and security that cannot be erased by software, regulations, or institutional failures. Recognizing this reality is key to understanding why stacking remains a vital part of wealth preservation, even decades after the first investment. The discussion also highlights economic and market signals that impact stacking strategy. Recession fears, employment declines, mortgage risks, and potential policy changes all affect liquidity and behavior. Savvy investors treat these fluctuations not as threats, but as opportunities to accumulate more metals at favorable prices. While premiums on sovereign coins may rise or fall temporarily, private mint products often provide cost-effective alternatives, allowing disciplined accumulation without overpaying. A recurring lesson is the value of long-term vision. Accumulating steadily, understanding market psychology, and observing trends in premiums and scarcity create an advantage that reactive buyers lack. Experienced stackers recognize patterns in supply, demand, and sentiment, using this insight to position themselves ahead of potential market shocks. Combining strategic planning with practical, flexible holdings ensures both protection and growth potential for the future. In conclusion, physical gold and silver remain an essential hedge against systemic risk. The mindset of patience, discipline, and practical use separates serious investors from casual participants. Understanding generational behavior, premiums, and market signals allows for informed, strategic decisions that can preserve wealth through volatility and uncertainty. Thank you for watching this detailed breakdown here on Gold Rush Reporter. Make sure to like, comment, and subscribe to stay updated on the latest insights into gold and silver markets. Share your thoughts in the comments below. Do you focus more on coins, bars, or a mix in your stack? Your engagement helps us continue delivering in-depth analysis. Stay informed, stay ahead, and I'll catch you in the next video. Sample text.